One.
We are back. It's Sunday evening. It's time for the futures market open. You're watching Tasty Live. This is First Call. I'm your host, Chris Vecchio. He's Ilya Spivak. Ilya, I hear that your flight's delayed, but you're going to be in Chicago this week. I'll be meeting you there in a few days' time. Looking forward to having you in studio, having myself in studio. That should be a fun. It's been a while. That should be a fun bit of time.
Absolutely. We're going to be walking around, or at least I know I'm going to be walking around like a Smurf the entire time because my California disposition is not made for these temperatures. I've been out of Russia a long time.
Well, here in New York, we have about 15 inches on the ground so far, and my weather app says about 5 to 8 more coming. I've been fruitlessly, hopelessly, Sisyphusly, is that a word? Shoveling snow in my driveway and walkway all day just to make sure it's not so terrible for tomorrow. There's like 8 inches on the driveway again since when I last shoveled. It's great. It's really demoralizing, Ilya. But you know what? We have a lot of moralizing, uplifting to do here this Sunday night because it's a big week ahead for these markets in many different facets. The way that we're going to do the show here tonight, we're going to take a look at our top volatility movers just to help frame what's been going on in markets over the past week, see where the volatility has gone up, where it's gone down. We're going to take a look at the top earnings releases about 5 or 10 minutes in, the top macro events, any treasury auctions that might be of interest. That way we can help frame the binary event risk that's coming up in the context of recent price action. And then, Ilya, at the end of the show, in the last 5 or 10 minutes, you and I will go through and we'll provide our top trade setups for the week, how we're approaching these markets, because it's a really important week. And I got to say, thank goodness that we were able to focus on the storm here in New York and, well, really across the country. Where can you say that a storm that's affecting Albuquerque and Boston in the same day exists? And yet here we are where we don't have any significant news coming out of DC, what feels like for the first time this year. We come into the year where that first weekend gives us the news of Maduro. The following weekend gives us Powell, of course, with Powell being subpoenaed. And then last weekend we have the news over Greenland. The market enters this week without that fray, that frazzled attitude, as we see here coming out of this Sunday where, despite whatever best laid plans of mice and men, it's a market that went into the close on Friday a little bit weaker. Stocks were down at the end of last week. It was a recovery for what it's worth because we do see that after Tuesday, I should say, because of the holiday. Markets are able to bounce back once Trump and co. reassign the focus away from Greenland. But it didn't stop things like gold and silver. And silver today looks like it's going to open about 30 cents higher if some of the pre-market reads are correct. It's up through 104 potentially. Gold on the march to $5,000 an ounce if you're on the GCJ6 contract. Now $5,020 at the close, as we see on Friday.
Last week getting shellacked at the open here too.
And that is really the story of last week as well, where we come not just with stronger gold prices, stronger silver prices, a little bit more stability in stocks. We're entering this week where the dollar really never does rebound. And the yen is starting to show a little bit of maybe has found some religion after there's rumors over the weekend or really on Friday that the Fed was asking banks for quotes. And you and I have gone through the intervention framework many times in the past, where the BOJ, the Ministry of Finance, will ask bank for quotes. During the U.S. hours, the Ministry of Finance has used the Fed to facilitate these trades because it's their trading hours. And so it appears that intervention may be afloat or afoot, rather, I should say, in FX markets. So there's a lot of different forces in play right now for this week ahead, Ilya. Last week, the volatility movers, as we start the show off here, what really changed in the course of this news? Natural gas, of course, was the big mover with the storm that came in and is impacting some 230 million people across the U.S. We had seen back-to-back days of 25% gains, which is almost unheard of. And I will forever remiss the fact that I did not get long before this rally. In fact, I was long deltas before the rally and closed out the position right ahead of time. So great timing, sir. And that I will never not regret that. goes into the box of many missed trade opportunities over the years. Crypto saw a little bit of volatility. Oil saw a little bit of volatility increase. And that's exactly where I want to start, because over the weekend, we didn't necessarily get that strike in Iran as the futures market opens up, and it's still a little bit firmer here, sitting around $61 or so. It is one of the many drivers that we have in this week ahead, where it's kind of a wild card, because unlike a Microsoft earnings, for example, or a Fed meeting, there's no time on the calendar with which something like this could transpire or occur. So as we start this trading week, Ilya, with its 47.8 IVR, an uptick from what we saw at the end of last week, let's start with the wild card here. Let's start with energy. How are you approaching energy markets for this week ahead, given the fact that it's probably so far removed from the other catalysts that we're going to be discussing for the rest of the show?
I'm not so sure that it's that far removed. I'm kind of looking at it in the context of the entire picture, because I think one of the main problems at root in all of this uncertainty is that the markets want more rate cuts than the Fed wants to give them. And the reason they want those cuts is not really because the economy is doing poorly or the labor market is falling apart. It's none of those things, as a matter of fact. The data suggests that the economy is doing reasonably well. The labor market has softened, but not by much in retrospect. And so we look at all this and say, okay, well, the Fed's baseline for the labor market for the past several months, probably not great. Compared with all of 2025, a little bit better, actually. And so when you look at what the markets really want these cuts for, it's because of the types of things you've just described. The Maduro situation, and then right after that, a subpoena of the Fed. And then right after that, the situation with will we or won't we strike Iran? Then Greenland, back to Iran. So the markets clearly are perceiving that what they need is some sort of buffer, some sort of safety net of cheap money. It's not that they know what the problem is, it's that they don't want to find out that they don't have enough liquidity when the problem presents itself, because problems keep cropping up and volatility around the headlines remains elevated. Crude oil is a huge part of this story, because it's the inflationary impulse that's going to keep the Fed from giving the markets what they want.
Well, you know what really does deserve the note here, the nod of the tip of the cap here, is the market gapping open lower here. And it does not, we're not going to get political here about this, given some of the events that occurred in Minnesota over the weekend, but the downstream effect of the news headlines out of Minnesota this weekend regarding ICE has been that Senate Democrats have said that they are going to withhold support for another government funding bill if DHS funding is included in the bill. Why does that matter? Because at the end of this month, the government shutdown that we ended back in November, it would resume effectively, because that was a short-term continuing resolution to keep the government funded for only a few months' time. And if Democrats are withholding the support for this funding bill because of ICE and DHS spending, well, we now add a new layer here to start the week. So that is the news out of Washington this week, and it's not something that the Trump administration is doing. It's a response by Senate Democrats to the weekend's news. S&P 500 down just nearly 0.8%. The NASDAQ off 1.1%. We'll call the Dow off by nearly 0.7%. And you have your Russell 2000 off by nearly 1%. You don't need to take my word for it. You can go check Polymarket. Those government shutdown odds have skyrocketed here over the past few days, from the teens, 20% up into the 70, 80% range right now. As it were,
dollars off 0.8% across the major currencies. It's looking ugly.
It's not great for the US dollar, and that bad news for the dollar is continued good news for gold and silver here at the open, with gold continuing to see that rise in volatility, which was a big part of last week, up 3.9% over the past 5 days. We likewise see that's IVR up 3.9% over the past 5 days. You see here that gold is up 0.7% to new all-time highs, 50.51. Silver up, was near 105 for the ever briefest of moments there before coming back in here a little bit, 104.73. It is a wild open here for the metals. where they had a very, very strong flash open to the upside and have moved here to the downside. And I get an alert, which is just obviously not great news at all. And I hate to be sarcastic and change tone, but the Patriots are going back to the Super Bowl, which is awful as a Jets fan, another punch in the face as a Jets fan. So Ilya, backing away from that real quick, the metals are obviously the hottest trade right now. If it's gold crossing 5K or silver breaking through the illustrious $100 an ounce for the first time ever, how does one approach these markets if they've missed this move? And I say that as someone who got out on Friday of my silver position, hoping to get back in at a lower level, and it's now $4 more expensive.
Yeah. I mean, this is what we were talking about last week. The idea that, look, you probably at some point have a level of speculative exhaustion. It's incredibly difficult to time, and it's going to occur at some point. And that probably means that you are not going to get out if you've been long this at the absolute perfect top. And as far as I'm concerned, if I've been sitting in a trade, and I'm not currently in silver, but I am currently in gold, and so thought process is not very different. If I've been sitting in this thing and I don't have to catch the absolute top, so be it. Because while momentum is here, there's no way to tell where that momentum runs dry. If you look at a lot of the sort of incremental indicators of where this momentum is, and you just look cross markets and say, is it just gold and silver? No. It's a weak dollar, it's weak risk, it's weak Bitcoin. The makings of the things that are driving this almost hysterical flood of capital into the precious metals, all those ingredients are here.
Silver immediately rips off the lows back to 104.70. It's a whippy open here for the metals. Gold back above 50.50. Ilya, these are some of the things that I'm very comfortable still trading on the long side. I was hoping to see silver pull back in a little bit. I'm a little surprised that we haven't heard of a CME margin hike again up at these levels, because clearing houses are going to do this as volatility goes up, as price goes up. They're going to increase margin. So the last time they did so was in the 70s. I had just rung, like, I was at 98% potential profit in the positions that I had, particularly in those in the follow account. So there was really no more reason for me to ride this thing into the sun. Freeing up the capital to get into other trades is perhaps the best use of that moving forward. But I got to say, I'm feeling FOMO because I didn't trade it through 100. I got out when it was less than 100, and now it's up at about $5 higher from where I last got out. I think this is the trade where you got to be still. I mean, looking for opportunities to get in. It's hard to justify it when it's running away from even the most aggressive of uptrends that we've had since, well, even January 8th. That low is at 73.53. How can you jump in if you haven't been already in at this point in time? So SLV is probably going to be the way to do it for most people. The silver futures themselves are bigger products. I prefer to go to fine risk if I'm doing this at all at this point in time. It's clearly breaking through even like the most aggressive of topside levels. We've had this Fibonacci extension drawn here on the chart for a few weeks, almost sarcastically, like, oh, $130 target. Yeah, sure, why not? That's just what the technicals call for, but that's exactly where we are. Mm-hmm. So this move potentially looking like it could be getting a little long in the tooth, a little exhaustive. Nevertheless, it's still the place to be. So I'm hoping for a pullback.
Yeah, I mean, until there's a reason to think that the move has run out of juice, there's no reason to think that. This is, as far as I'm concerned, a pure momentum kind of a situation here, and trying to guess before the market tells you where the exhaustion point is, fraught with disappointment, in my experience.
Okay, so last week we have the metals volatility going up. We have oil volatility going up a little bit. If it's geopolitics related, if it's not, I would argue it is. I also see here that among the volatility risers, there's some stuff going on in currencies.
Yes,
the yen,
very
of
much
course,
so.
is of particular interest. And for those yen intervention watchers like myself out there, maybe we caught this one this time.
Yeah, it looks like it.
We had those reports on Friday here. It's not just the yen, it's also in the Aussie. There was a little bump up in the pound, the Canadian dollar. Volatility
Euro.
is in the 20s, 30s. Yeah. It's meaningful. I'm thinking about the other side of this though too. The big volatility decliners last week. Bitcoin saw a big drop in vol, although this thing looks pretty dead in the water here. I've been trading this long and been getting clobbered in more than one way.
I've been sitting
you were
short again.
Yeah, I know that you were long, and then I think you tossed in the towel on that and flipped.
I did. The thing failed. I'm one of the things that I went into this year thinking is I needed to energize my faith in the idea that if a trade is wrong, then the opposite is right. And what that is it's a call to flip positions when your idea hits its risk tolerance and you say, what I thought was the trade is not it. Whatever I thought was the point of no return for the trade, whatever my risk cutoff was, it's been overcome. So rather than just exit, you flip the trade over. And that means that sometimes you're going to get tossed around. But the idea is that if you get tossed around, you maybe take a few small losses, but you mind your risk reward. And as long as your risk reward continues to be something like forcing a 2-to-1-esque type of thing onto your options structure, onto your stops if you're using outright futures or outright shares, then you'll end up with a few small losses and offsetting gains if the risk management is right. And I got tossed around a little bit in Bitcoin. I was short for quite a while. Then it looked like it bottomed and broke higher, so I got long. Then it's flipped back the other way. No harm, no foul. Small loss. I'm back short. Very manageable and looking for the next leg down now because it looks like whatever we just saw from November up until now increasingly has that pennant flag something continuation.
Yes, it does. Oh, and it's an ugly continuation because you get that breach through the recent highs, and it looks like that there's maybe just a chance of it bottoming.
That's what sucked me in right there. That range.
And that's what sucked me in. You are a better man than I, having flipped.
I immediately flipped it over as soon as it failed.
Maybe my measurement's off, and perhaps it is, but I am eyeballing it here. That Fibonacci extension, 52,000. Well. Hold on. Depends.
I'll take it.
Depends how you're positioned, sir.
Sold.
And for me, I don't know if I like that. Other than that, though, there are some commodities here. The soft ag is what sees the biggest decline in volatility over the course of the week, broadly speaking. Otherwise, it really was just a week where most products see a rise in volatility on the future side of the equation. I suppose, Elliot, this is as good a time as ever then to talk about what catalysts could drive volatility increases or decreases for next week, because we do have, or rather this coming week, because we do have a saturated calendar. First and foremost, there's the Fed meeting on Wednesday. I want to start with macro first because that's more or less our wheelhouse and what you and I care about more than anything else here.
That's true.
Government shutdown odds increasing. That probably doesn't affect the Fed up front because a shutdown hasn't actually happened yet. It won't warrant much of a conversation from them come Wednesday. They're much more concerned with the broader state of the economy, which, in fairness, if you're looking at the scoreboard right now, it's difficult to say that the last government shutdown posed any significant impediment for the broader economy. The unemployment rate's still below 4.5%. Growth for the third quarter was north of 4% in real terms, north of 8% nominally. We're looking at 5% growth plus potentially for the fourth quarter. Inflation's sticky, so that's not great. But you know what? Given everything else, it feels like the Fed doesn't have much of a reason to cut as is, and you can't really argue that the last shutdown impaired the economy. So what's the Fed's deal this Wednesday? I mean, I'm looking at the S&P 500 and the options chain. I'm thinking about where the market's priced through the next few days. I see close to 100 points through Wednesday's close. That's still less than 2% between now and Wednesday, given the fact that we have seen volatility rise here at the open.
That's right. I don't think anybody had any serious expectations for a policy move at this meeting. And frankly, if we had a policy move at this meeting, I think the markets would be shocked. And that would be a tail risk kind of an event, because we've been looking at this meeting as a foregone conclusion, hold rates where they are and update the rhetoric kind of a meeting for months and months and months. Even when the markets were getting their guidance from the Fed in August at Jackson Hole, and then with that September meeting where they updated their summary of economic projections and actually started the cuts, markets were convinced that January was not where one of them would land. And that conviction has only strengthened. We're now looking at 97% chance that nothing's going to happen. But I don't think that is a market moving outcome. That is to say, if the Fed does nothing, that isn't an impetus for markets to decide this or that. They know this already. The question is, what will the Fed say? And in particular, what will Powell say in the press conference? Because obviously, since the last Fed meeting, we've had these subpoenas. He's going to be asked about them. We got the Lisa Cook thing coming up. It may or may not see some kind of a decision by the Fed meeting if it were to get rushed out here. Obviously, there's not much time, but it does look like, reading the tea leaves out there, that maybe we're in a situation where Lisa Cook is going to get to stay, and the Fed is going to get told that the president couldn't fire her. And so there's a number of things that are lining up here, all of which are seemingly telling markets there's going to be more volatility, not less. Because if you assumed that the Fed was going to get a dovish tilt because the president was going to manhandle it to his desires, you might be told otherwise here in the next several days. If your baseline was that the president's tariffs were settled sometime over the summer because they took shape and the markets acclimated, well, that might get tossed out the window too by Supreme Court action in the coming days and weeks. So if you're the Fed, you're going to have to field all of these questions in the press conference, and how Powell answers those questions.
Do anything about any of them.
Right? So what Powell says with the oil price rising, et cetera, that's going to be very interesting. And if you look at sort of what is Powell likeliest to do? Say nothing, stay vague, commit to nothing extra. That is not what the markets want him to do. The markets want him to say something to the effect of, holy moly, look at all this stuff. Maybe we need to cut sooner. It looks like there's instability in the wings. What's the likelihood that Powell does that?
We have a storm.
Very low in my mind.
We have a storm that could be bad for corporate earnings, Ilya, could be bad for employment, particularly for those southern states, which, unlike here in the Northeast, we keep the plows and the salt around for these kind of stuff, these kind of events. I'm assuming the roads are going to be cleared by noon tomorrow, and we'll be able to go about our business regularly. They canceled school, but for everyone else in the country, this is a major impediment. We didn't have hurricanes in the fall. One of the reasons why the economy didn't lose momentum. So can't discount the fact that this storm could be one of those reasons. But I count, Ilya, now I'm thinking about this. So we're going into the Fed. They have all these, what's its or whodunits out there with no answers, at least in the short term. So they can't act on anything.
Right.
But we have geopolitics in play if it's fraying tensions with Europe, but it could be Iran, as Trump notes, the Armada is on its way there. So it could be Iran. It could be something to do with Venezuela. We also have the government shutdown in play. So there's a lot of things that don't have an expiration date on the calendar. While the Fed meeting on Wednesday does give us a 2 p.m. Eastern, starting point, and then 2:30 Eastern, 1:30 Central, we'll have Jerome Powell go to the podium. Can't say exactly that there's much of anything else coming out of DC that has a firm point in time, as well as the tariffs. If we want to sprinkle that in for good measure, because you mentioned that as well. The tariffs is point number 3. We don't know if and when they'll make a ruling on those. So, hey, what do we do know? Well, we do have earnings this week. The first half of the week, some items of interest, United Healthcare, for example, has drawn a lot of attention, both in the media and in social media, both traditional media, social media in recent weeks. We know that the defense names have had just an absolutely wild run the past few weeks, given some of the headlines and Trump's desire to have a $1.5 trillion defense spending plan for this next year. Raytheon is on Tuesday. Boeing is on Tuesday as well. These are interesting names. Texas Instruments starting to get into the AI portion of the story, but it really feels like it's the second half of the week, Ilya.
Yeah.
Where we have the meat, not just for that Fed on Wednesday, but really everything.
Everything else on Wednesday, too.
Microsoft, Meta, Tesla. I mean, that's it. That's the ball game. I know we have Apple on Thursday, but Wednesday is the day for everyone. If you're a macro person, if you're a stock person, you don't care about the Fed, Wednesday is the day that you're going to be paying most attention to markets.
Yeah. Yeah. I mean, it certainly looks that way. And there's a lot that's up in the air here until then. And as we're watching here, markets find a path of least resistance before all of that event risk. It's interesting that that markets are as defensive as they are, because normally you would expect something of a sideways drift before this kind of event risk, where the markets go, you know what, I don't know which way to jump, so I'm just not going to jump. I'm just going to wait. But with yen intervention out here, the yen rocketing, the dollar lower, gold up as aggressively as it is, oil up again, doesn't look like the markets are waiting.
You know, interestingly enough, on Wednesday, we have Tesla, we have Meta. I'm still sitting long delta positions in both Tesla and in Meta. I really like the short put spreads, the opportunities that have presented themselves from both a technical and more of like that typical tasty quantitative perspective. The volatility profile here in Meta going into this 34.3 IVR, we have this little series of higher lows. There's a little bit of divergence in the indicators as well, given the fact that this market is producing somewhat of a bounce. Meta has really been left behind. And if the NASDAQ is going to see any semblance of a significant rally, we're probably going to need Meta to start participating. Curiously, Ilya, if we find ourselves trading in 700 or so by the start of next month, which is really just around the corner, we're talking about next week, then you start to see the posture of this chart take a little bit of a different shape. Microsoft as well, it had a really nice end to last week, up 3.3% or so. Hasn't been able to scale any significant momentum levels yet, but maybe the tide is turning. I want to see this to like 490 before I start to feel really jazzed about it. But you can start to see the contours here as much as, we may squint and want to see it. You can see some of the laggards that have prevented the NASDAQ from making any significant headway in recent months. This may be their window to actually change the narrative and turn the corner. And if you can't come Wednesday, and I think this is the ultimate takeaway, if you can't see a Microsoft break out and shake off the whole bloated AI, too much CapEx, not enough actual earnings, not enough productivity to justify continued spending story, this then starts to look like a bit better of a market come February 1st. If you're trading any of these, because I have short put spreads in Meta, in Tesla right now, and I'm going to hold them through the earnings releases. Microsoft, Meta, Tesla, if you have to look at any one of these three, which is the bellwether for you that will move the market the most, that markets care about the most?
I think probably Microsoft. Tesla seems to be kind of marching to the beat of its own drum somewhat. Microsoft seems to be much more of an avatar for the broader narrative. Something I've been thinking about increasingly is once you actually start to see ROI numbers out of AI, that may very well be the top. Because if AI is an efficiency making sort of thing, and we obviously talk endlessly about it disrupting employment, disrupting this, disrupting that. If it is in fact an efficiency making thing, then it allows companies to make the same stuff just cheaper, in effect. It doesn't create new demand as such, not for a while. Meanwhile, it displaces anything that it does in replacing employment, in streamlining up expirations, in encouraging layoffs. That's demand that's lost because those people are not consuming like they were consuming. And so if you start to see real ROI on this stuff actually begin to materialize, that's probably the place where its implications for economic growth become suspect. And you get away from extrapolation and toward, okay, this is the part where the actual business cycle and the level of demand is. This technology doesn't increase demand, but for itself, we're seeing that now. And then once the build out is done, it's done. And so there's an interesting sort of thing here. I mean, obviously, this technology does wear itself out relatively quickly. Chips become obsolete. You do have to build more. But if companies actually start seeing ROI, that's because they've rationalized. And if they've rationalized, consumer demand has been lost. So, and consumer demand is what drives the economy.
Well, Ilya, as we think about these earnings, you mentioned that Microsoft's probably the one that matters the most to the market. I think the market's agreeing with you. We have an IVR 41 nearly in Microsoft. Yeah. It's more than Tesla. It's more than Meta. Although Meta has a bigger IVR than Tesla by a wide margin, and it's close to Microsoft's. And I think you could argue it's because Meta, too, has had a lot of missteps. They're eating how many billions of dollars in the metaverse? Yeah. As they shift to AI. So, they're going through some things too. Interestingly enough, with all these earnings reports this week, and we have Apple on Thursday as well, I think it's worth noting that a few weeks ago, the SEC approved an expansion of option expiries for the Mag 7 names, which is bringing the market ever closer to having single stock expirations or daily expiries and single stock expirations. So this now allows, starting tomorrow, believe it or not, contracts expiring on Mondays and Wednesdays for Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. All likewise with Broadcom and the State Street Financial Sector Spider ETF included in the listings, according to Yahoo Finance here. So that goes live again tomorrow, starting January 26th. There are Monday and Wednesday option expiries for Google, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla, Broadcom, which is Avgo, and XLF. What a time to be alive. Ilya, I'm not trading any of those Monday or Wednesday expirations this week myself, but hey, the more trading opportunities, the better as far as I'm concerned. Just careful with how you approach this. Speaking of approach, let's quickly talk about how we're approaching next week. I'm sticking long with my yen position here because if we are intervening, then I don't want to be on the other side of an intervention. Hey, finally, one of these worked out. That's working out pretty well. I don't think the market's going to care about a government shutdown because historically speaking, markets have risen during government shutdowns. It always provides a shock to the system up front because no one's getting along. And that's bad. And it is bad for a variety of reasons, particularly for the reasons why the odds of this government shutdown have gone up. But the market looks through whatever's happening in the news and it prices what's going to happen in policy and in earnings. And typically government shutdowns don't really matter all that much. So, Ilya, I think going back to the 1970s, S&P's averaged 0.3% to the upside during government shutdowns. I know the headlines this weekend are provoking this expansion of volatility, but as mechanical, data-driven people, we need to stick with what the data tells us, okay? So we don't overreact and we don't get too emotional about what's clearly an emotional situation. Beyond there, that means I'm still leaning long deltas in equities. I really like the long deltas in gold, which I'm waiting for silver to come back in. But for those that were with us on the $5,000 calls that we purchased a few weeks back, those expire in 90-something days. So we have a lot of time on our hands, and I think these can continue to do a heavy lift. Beyond that, I'm just going to wait for the Fed. If you're right, then it's going to be difficult to imagine a market that rallies too substantially on Wednesday because we have so many risks piling up.
Yes.
And the Fed is not coming over the hill with Gandalf and the Riders of Rohan to save the day.
That's what it seems like. And so I'm short risk here, be it Bitcoin or SPY, so S&P or NASDAQ via the Qs. I've been sitting in those positions for about a month and a half already. And I still have about a month on those options until expiration. So I'm not going anywhere fast. Still looking at that October high and the inability of markets to clear it, in particular, of course, NASDAQ and S&P. So I'm just playing for that top to hold. I am also long gold still. I rolled it out into the J6 contract on Friday, and as we talked about on the last call. And so I took a bunch of profits and I'm back at it again until, and as such, the market hasn't turned, and so neither have I. I'm still looking at the short side for the dollar. I don't have the yen at this point. I'm looking for it to find some kind of a reference point to structure risk reward against, but I'm long the euro, I'm long the pound. I'm short the bonds at the long end and in the belly because it looks like there might be more risk premium that comes into those. And I'm long crude oil at this point in size, and I've got 82 days to expiration on those call verticals. So it's moving real slow now because there's very little delta exposure this far out. But I'm looking for this rally to build and for the impact to multiply. The closer we get to expiration and the harder oil rallies, the more impactful it's going to be on P&L.
Ilya, you and I are done here for the moment. Tasty Live is taking a brief break. It's going to be back on air tomorrow morning, same time, same place as we are every Monday through Friday, 8 a.m. Eastern, 7 Central Time. The Batman will be live. I think the next time the audience will see you, you'll be in studio.
Yes,
which
sir.
is good news. So hope that you have a safe flight to Chicago. For everyone else, good luck trading tonight. Watch the headlines. They're moving these markets. For Ilya Spivak, I've been Chris Vecchio. Good luck trading. We'll catch you on air tomorrow. You've been watching First Call. This is Tasty Live.